Our next guest suggests affluent consumers are the key reason why overall spending looks strong. Stuart Sopp is CEO of Current, a fintech company. Stuart, great to have you with us. You're seeing firsthand what consumers are doing.
That's right.
What are they doing?
Yeah, so at Current, we deal with the consumer, the average everyday American. And they're spending on staple goods like you've just mentioned in Walmart, Amazon, Target, Home Depot, places like that. That spending is rock solid. It really hasn't moved that much. So what they are doing is getting less for their money. And so for staple goods, that's obviously something that's new for Americans. That's just happened. And you're seeing that roll into retail sales coming lower, retail confidence. So the confidence numbers are coming down on the indices. And so from a consumer point of view, they're saying, okay, I'm not getting as much money as I'm not getting as many goods for my money. And then I'm having to spend more money through credit card debt. We hit $1 trillion on that for the same goods. And so for the average consumer, they are not exactly struggling, but they're also struggling to make that money go as far as they traditionally would.
So, Stuart, you guys obviously have this debit card, and now you just introduced a credit product here. So it's interesting when you think about like the average consumer and you think about the places in which they're spending. Are you starting to see some data that shows, you just mentioned $1 trillion in consumer credit, are you starting to see any sorts of shift that would lead you to believe that we're going to start getting to territory that feels uncomfortable for a consumer, that maybe many in your demographic are going to start to repay student loans, that sort of thing? And so I'm just curious, do you track that?
We do track that. We're not seeing any. We're seeing mixed signs is probably the TLDR for us. From an affluent standpoint, which you guys have just mentioned, 22% of credit card debt has been pulled down just now. So you've still got 78%. If you want to take a bullish view for the consumer, 78%. So for more affluent people with big credit lines, the average household has $8,000 on their credit card from $6,900 in 2019-2020. So there's still some way to go for the more affluent households. 90% of all mortgage rates are locked in below 6%. And so for many people, they're not going to move house, they're not going to move jobs. And so if you want to take a bullish look from a more affluent point of view, there is some dry powder there to go. Now, for the average consumer, the average American who's trying to make those staples go as far as they can, I don't think there's that much breathing room for them. And so credit building is such an important part and in your credit score is such an important part of your APY of how much money you spend on your debt. We've never needed to look at that over the last 10 years, right? So you've got debt and it's just been like whatever it is. Now, because you're sensitive to that interest rate, you're now going to look at the inputs to that, which is like your credit score. And so we've got this product called Build, which helps people, everyday Americans, build their credit with their bank account.
What's your take on how consumers view that dry powder, that remaining credit line that they can still use if the interest rate is 26% or whatever horrifying rate it is these days?
Yeah, I think this is what's coming into the psyche of like whether you pull down or not. And so definitely when it comes to mortgages and auto loans and things like that, you're probably not going to look at them too often. But when it comes to revolving credit, I do think if it comes to staples, which is starting to happen now, you are going to pull down on that line. You're going to feed your children, you'll feed your family over 22, 24% on that APY. And again, that's why I think that credit building and maintaining a good credit score in this time for people on 25 to 55K, somewhere around there, 75K household income, it's a really, really important thing to do for this year.
In a former life, Stuart was a trader at Morgan Stanley. So it's great to have him on here from his view. What do you make of the bond market moves and some of the currency moves that we're seeing? Obviously, it's no impact on the stock market, but is it just sort of inevitability with that?
Yeah, good question. So I think when it comes to the retail stocks that you're seeing right now, I think you will see earnings beats and revenue misses. But overarchingly, what we're going to see is liquidity draining. So the bond market's going to drain the liquidity. It looks like it's happening already. And so we'll see this sort of volatile to sideways move. We're all going to make bets. I heard you make a pairs bet just now. So we're all going to be making these bets, but and I'm sure they're smart. But I think over the next 2 or 3 months, the overarching theme will be liquidity drain. We have too much issuance. The Japanese market is in turmoil, although the BIJ are doing a good job, I think. And I think that'll be the dominating factor over the summer until we get back, until everyone's back from Labor Day.